Welcome back. Here with us on Bazaar Morning Call. We've got Dipan Mehta joining in. Of course, he's from Elixir Equities. So let's get some thoughts going with Dipan. Dipan, good to have you on. To start off with, I really want to take up this whole business around life insurers because it's been so many months of policy uncertainty. Finally, I think we have the full and final, surrender value norms. And they seem to be slightly penalizing from, not from the policyholders' point of view, but from the product manufacturers, the company's point of view. What's your sense on life insurance?
Thank you for having me on your show. I haven't really studied the exact details of this surrender value regulation. But look, life insurance is a great business. And end of the day, the industry has been able to navigate through many such regulatory changes, tax changes as well. And there are minor subdued demand or a minor hit on the profitability. And then it's business as usual. And the most important thing is that these products are being understood better, and the entire industry is going in for products which are more profitable. From that point of view, I think very positive on the insurance companies per se. I think valuations for private sector insurers also have come down to reasonable levels. They're going at 4 or 5 times now. They're in the range of 2 to 3 times their enterprise value. And of course, there's this behemoth LIC. And yesterday, particularly on your channel, I saw this presentation on LIC where they actually increased their market share as compared to private sector insurance companies. And that, I think, is a very bullish sign from LIC. And considering the valuation, considering that they have such a large exposure to equities, this is one company we have a very positive view on. Having said that, we and our clients are invested in LIC, so our views could be slightly biased from that point of view. But there's a company where there's scope for the valuation ratios to be re-rated higher. And of course, it's a PSU stock, which is the flavor of the season. And I think earnings also and new business growth also can compound steadily.
So I got that. And we'll talk more about this on the insurance side as we go along. Dipan, hi, morning. So immediately, what are we looking at? I mean, you got a big sort of down move in yields overnight. We got the Fed out of the way. So where will we see as an immediate reaction function? Will it be metals? Could it be banks and financials, IT services, or not the traditional IT services, but maybe some of the a few which react a little bit more whenever we have yields come off? What's your sense? Or you think a lot of it is already in the price because we've been moving up non-stop?
John, good morning. It's a multiple choice question, and I take on IT services. So if NASDAQ and US economy do well, then I think IT services should do exceptionally well as well. And the interesting bit is that across the board, IT services companies have been getting a lot of contracts. Order books are looking good. Contract values are looking up. It is that execution was a problem last several quarters or so. So I think if there is more certainty in the US economy, and if the entire Fortune 500 companies start to look at growing their expenditure and investment in technology, then at least IT companies will see immediate benefit of it. And at least the execution will start on a lot of these multi-year, multi-billion-dollar contracts that these companies have signed. Even if the work has started, it can be scaled up. So very positive on IT services, and per se, the great operating leverage businesses as well. Even a minor uptick in their revenues, a lot of it can flow to the bottom line. The entire pressure on costs also, mind you, has come down. I think hiring costs and salary increments are more down to earth now. And a lot of IT companies are using productivity tools within the AI space to improve their cost structure. So from all points of view, I think IT services should have a good year, 24-25. And they have been laggards so far, but I think they could easily catch up over the next few quarters or so.
Okay, all right. Hi, Dipan. Good morning and good to see you in. Dipan, I need to ask you about the cement space. I put out 4 reasons earlier this week as to why the stocks were buzzing, but now it appears the 5th reason has come about. That's normally the low-hanging fruit. There's talk of consolidation, larger players want to get larger. The Adani Group, Adani Cement listed companies, so some articles are stating today that they are on the prowl. We've heard that in the past, but actually not much has happened, barring the Sanghi asset. On this inorganic growth, will you be looking at buying some of these mid or small-sized companies?
Very difficult to say now which is the next target because not just the Adanis, I think all the large cement players are looking at acquisition. The balance sheets are extremely strong, and they know that they have to get market share at any cost because a lot of expansion is taking place within the industry, and by acquiring a new player in the same area or a different geography can certainly expand their marketing footprint as well. So yes, I think if there's an opportunity, I tend to think that industry players will overpay for it. But look at the dynamics of the cement industry. I think from what I read, a lot of the cement prices have been stable to have come off slightly also. Overall construction activity has been low in summer because of very hot summer season. And now we're entering into monsoon, which is also a low key activity. By then we'll have even more capacity coming on stream. So the picture is getting very muddled as far as cement is concerned. And I know I've been quite bearish, or I would say neutral on cement, and companies like Ultratech and I would say Shree Cement, even ACC have reported exceptional numbers. But I think that considering the valuations, considering the industry, the capacity build up, as also the fact that input costs will gradually inch up for these companies, and I don't think they have as much pricing pressure. So look at the full picture. At best, I'd like to be neutral weight, definitely not overweight, and that too in select companies and very efficient players, maybe like a Ultratech or even a Shree Cement.
All right, Dipan, quick comment on a couple of these consumption names. Yesterday you had Dabur, that was a relative outperformer. What do you like from the FMCG pack?
Nigel, actually nothing in the FMCG pack. I know that investors have been gung-ho because they expect the center to spend more on rural and that would increase rural consumption. But there are other ways to play it, and could be auto, could be appliances. I think better way to play agriculture, maybe even fertilizers and agrochemicals. But I'm not that positive on FMCG. I think a lot of categories over there are pretty much mature, and volume will remain pretty tepid going ahead.
Okay, all right. Stay on, Dipan. We'll have some more questions for you in just a bit.